This is a market update for Chicago, Illinois, April 2014, presented by Chicago City Estates. Conflicting headlines that look at different data regarding the quantity of home sales over the past year may be confusing. Some say sales are up and some say they are down. There is no doubt a lack of inventory, which can certainly have an impact on whether there are homes to be sold. Let's take a closer look at home sales from the past year and see why the data seems to be conflicting. Looking at this chart, we can see that nationally home sales are down in the price range of $250,000 and less. However, everything over $250,000 is up, and increasingly up, in each of the categories to over $1 million. Considering the median price for homes in downtown Chicago is above $250,000, we're looking good. See more detail about the downtown Chicago market in the accompanying blog post. If you lump all of these sales together rather than breaking it apart, it's not a pretty picture. But economist Elliot F. Eisenberg explains the dichotomy we should be looking at. While many fret that existing housing sales have recently been slumping, the angst is misplaced. Since early last year, sales have declined 7%, but distressed sales as a percentage of all sales have fallen from 25% of sales to just 15%. Thus, the total volume of non-distressed sales is higher than it was a year ago. Relax. Here is the data to give you a more clear look at the overall picture. Short sales are down 44%. REOs are down 16%. But in the non-distressed categories, existing homes are up 18%, and new construction is up 23%. Not only are non-distressed sales up, but new construction is up. Look in your neighborhood. How is your skyline changing? If you have been thinking about buying, you've probably been keeping an eye on mortgage rates. 1 point can make a noticeable difference. Recently, we have seen some pretty amazing rates, but they are moving back up, which is scary for some people. Hopefully this graph will calm your fears and help you see more of the big picture. This shows the average rate over the past few decades and the payment that rate would yield for a $200,000 home with a 30-year mortgage. Today, the rates are hovering under 4.5%. Looking back, this number is still quite incredible. The monthly payments at today's rates are 20% lower than they were in the 2000s and 54% lower than in the 1980s. Rates are rising, no doubt. In fact, experts expect them to go up by about 1 point by the end of 2015. If they do reach 5.7% by then, they will still be lower than the 6.29% we saw in the 2000s. This is good news if you are not quite ready to buy yet, but will be in the next year or so. However, if you have all your ducks lined up and you haven't bought because you are hoping to get a better deal financially, take this into consideration. This chart compares the same home and how the numbers would look today compared with how they will likely look in a year. Today, the home is worth $250,000 and interest rates are at 4.41%. If you bought the home at that price, your principal and interest payment will be $1,253.38 a month. If you wait and buy the same home in a year, the value of the home will increase to about $270,000, so you are already paying an additional $20,000 for it, and your interest rate will be higher. We are predicting it to be at 5.7%, making your monthly payment $1,567.08 or an additional $313.70 each month. What if you were able to buy today and put that $313 aside each month into a savings account? By the end of the year, you would have $3,764 to spend or save how you choose, rather than tying it up in your home. Whether you are thinking about buying or selling, now is a good time. With low inventory levels, homes that are in good shape and priced well are going under contract in record time, and continued low interest levels are keeping homes affordable for buyers. For more information about how sales, inventory, and prices are affecting the Chicago market, check out our accompanying blog post.